welcome to Dave, Bath, and Beyond, where we're all about mortgage, loans, and more.
And more.
That's right. My name is David Dowd, and I'm a loan officer with my own company, David James Investments. My brokerage is Equity Smart Home Loans, where we can do loans through over 150 different banks.
And I'm Bathsheba Payoute. Welcome. I'm happy you guys are here. I'm a loan officer in Florida, and my broker is Gross Capital. We also have 150 banks that we do loans for. We do QM, non-QM loans, equity, HELOCs. We're here to help you. Thank you for joining us again.
And also, before we
Yes.
get started, if you wanted to follow along, I'm going to put a link up here where you can go to the website that we're going to go to here in just a moment. And also, as a disclaimer, to get that out of the way, today is August 25th of 2024 when we were recording this. And so just keep that in mind if you're using this as your guideline reference. Always double check the guidelines, because if today is not that day, and even later that day, it could be different.
If you have a question, please ask us. We'll be happy to answer it to the best of our abilities.
This is a conversation, and we want you all to be a part of that. Okay, so we should be able to see the screen right now.
Yes.
And we are in the Fannie Mae guidelines, and we last time had gone over the fixed rates and the adjustable rate mortgages with a nice little math equation. So if you didn't see that episode, make sure to check that out. I will probably put a link to that in the corner of the video. But for this one here, today we're going to be covering two sections: the convertible ARMs, as well as the temporary interest rate buy downs. So we'll get it kicked off here with the convertible ARMs.
Convertible ARMs are arms that perhaps you got it from a different lender, that you can go ahead and change it to a fixed rate mortgage, and Fannie Mae will accept it. So Fannie Mae will accept deliver of a fixed rate mortgage that were converted from ARMs, as long as it's been legally executed and modification agreement, which means that in the details, your sales agreement, that it says that it is going to be transferred to a fixed rate. Either you're doing this by refinancing it when you get a whole new loan and a whole new loan term, or under the provision of the mortgage instrument. So when you had signed the ARMS agreement, you had said that eventually that you are going to change this into a fixed rate. And it is a written ARMS agreement.
These convertibles, right? I think that's the key word here, converted from. And so we have an ARM, which, as we talked about last time, it can be kind of risky, right? Yeah, ARMs. It can be rather risky, though, when it comes to adjustable rate mortgages, not so much our ARMs.
Right.
So that's one of the things that we have to keep in mind, that if we get into a riskier, lower interest rate, bear in mind, that's the reason people do it, but eventually things are going to change over time depending on the ARM you get. And so we want to make sure that if we're converting it to a fixed rate and we want to utilize conventional financing, that being Fannie Mae as one of those entities, then these are the guidelines that we're going to be referencing when we're doing that, especially Fannie Mae, if we're not doing Freddie, for example.
Right.
So that's what it basically talks about here in the general information section, as it then goes into the mortgage-backed security pools.
So the converted ARM that is removed from the ARMS MBS pool. So what is the ARM MBS pool? It's basically a group of mortgages held in a trust as collateral for an insurance of a mortgage-backed security. And as a result of this conversion to a fixed rate, mortgages may be redelivered to Fannie Mae. So Fannie Mae deals with hundreds of thousands of loans, and they put these ARMs in a special pool just for protection for themselves. So if one wants to be moved and be converted to a fixed mortgage rate, they allow so. The guidelines for that is that if the mortgage is more than 12 months old at the time of redelivery and the lender specifies the market rate post-conversion deposition option, the mortgage must meet the same eligibility criteria. So it's basically saying that if you had this ARM for more than 12 months, then it can still be redelivered, even if it's not the same criterias or rules that Fannie Mae usually does not accept. Because since you're converting it to a fixed rate, it's going to have its own new terms, its own new legalities. So that's why they will accept it.
This goes back to my ongoing analogy of the cookie cutter, right?
Yes.
It's like, well, it doesn't matter where it came from. If it can convert, that's the first thing. If it can convert, then here's the deal. It's going to convert to something that we want, our cookie cutter shape. the shape
Yeah.
of that said cookie cutter. So that's why I keep saying, you know, and is in line with Fannie Mae fixed rate guidelines and is in line with whatever Fannie Mae says about ARMs, things like that, depending on what you do. So this mortgage-backed security pools, right? It's like pools. What? I know we've talked about this in past episodes briefly, but we're putting it together, like she said, in a trust, right? Bathsheba was mentioning a trust where all these loans are together, and they must be, in most cases, similar to each other. They got to have something about them that puts them all together. And that's just an investment tool, if you will,
Right.
for investors to be able to put their money in there for growth and also allow people to be able to remove from those pools later. They have those different options. So it's like, oh, look, it's getting removed from the pool. We don't really care too much about what it was because those were different guidelines, different entities, different investors. We're just caring about what it's going to become if you're going to go with Fannie Mae. That's
Right.
what these guidelines are mainly talking about there. And then we have the requalification and consideration for the fixed rates converted from ARMs and redelivered under market rate post-conversion options. Man, that's a mouthful.
Yeah.
And this section was extremely technical. So if you don't have a lot of knowledge about mortgages and how they work, this will probably turn you off a lot as far as like, what? What are they saying? Huh?
Right.
Long story short, what it's talking about here is, hey, if you want to get a loan to be a fixed rate that's already an ARM and it's with Fannie Mae and you want to go with Fannie Mae again, but you want to go
Mhm.
fixed, that's what this starts talking about. It's like within the same
Right.
entity, as it will go into more details with the eligibilities to follow. But basically, it's saying, you know, hey, there's a section on here that I remember it says right here, actually, the lenders can use the original in file documentation to evaluate a borrower's financial ability as long as the borrower is able to qualify for the mortgage based on either of the following, which is the mortgage interest rate in effect following the conversion and Fannie Mae's current underwriting guidelines for conventional fixed rate mortgages, excuse me. The mortgage interest rate in effect for the ARM, this is the other condition, mortgage rate in effect for the ARM when it is originated and with the underwriting guidelines Fannie Mae used for the ARMs at that time. First time I've seen where it's like, hey, you can use the same documentation you've used before
Documents.
on this transition or conversion, if you will. I don't think I've ever seen that. It's like usually you got to get everything new again, right? It's like,
Everything. And this just saves time, this saves energy. It's a really good opportunity to take advantage of. So if you guys didn't know, like please take advantage of it. If you have an arms with Fannie Mae, go back to your lender and see, hey, can I convert it to a fix without having to do a whole new application, without doing a whole employment verification, because all that's already in the file.
I would go in with the expectations that you might have to, because it's probably a higher statistical chance. However, as Bathsheba was saying, it's a potential option, right? Those two conditions there, either of those two conditions are true that's mentioned here. Obviously, this is more meant for loan officers reading this to understand because it's like I said, it's a lot of legalese, it's a lot of
Yes.
jargon. So definitely reach out to us or your loan officer in order to find out more information about that if that's your condition. But then following that, it basically just says, hey, if it doesn't work for those conditions, guess what? You're doing everything again because
You're doing everything over again
pretty
from
much.
scratch. We're
Yeah.
getting a new credit report. We're doing a new loan application. We're checking your income. So it's just a brand new start from scratch application.
Eligibility requirements for converted ARMs.
Just remember that your ARMS adjustable rate mortgage must have been at least 12 months old before when the conversion began. So that's very important. And your payments have to be on time too. If you see there, it says to minimize processing delay, Fannie Mae considers a mortgage current if no more than 45 days have lapsed since the last payment installment. Be mindful for your payments. It can't be more than 45 days, then they will consider it. The age of the mortgage is calculated from the date that the ARM was originated. So it's very important that you have these ARMs for at least 1 year before they will consider redelivery or converting it over to fixed with Fannie Mae.
Well, I figure I'd take this opportunity to talk about
Mhm.
something we've yet to talk about, and that is, well, why 45 days?
Yes.
The way it goes in the mortgage is, for those of you who have a mortgage, this is going to be old news, but for those that are new, first-time home buyers, this is going to be big.
Mm-hmm.
So the due date of the mortgage is traditionally going to be on the first, exactly, the
First month.
first of
Mhm.
every month. And
Yes.
then it's considered late as of the past the 15th of
15th.
every month, right?
Yes.
So now, oh, it's late. Here's, late fee, whatever the lender's conditions are.
Yes.
And then from there, past the 30 days, it's now, that's where we start getting into the foreclosure and we start getting in that direction. Now,
Right.
obviously, they want to try and prevent foreclosure. So even at the 30 days, they're going to send another warning. And at the 45 days, that's when I believe they truly begin in most cases. Now, don't quote me on that because every lender's a little different. In most cases, 45 days, that's when they begin the foreclosure process or start to try to recollect on the home that they gave you the money for. That's why it's the 45 days, because it encompasses that whole timeline. That's not going to be any of us because
Yes.
we're going to pay our bills on time. And the reason why this is also important beyond mortgages is that's how you get good credit. If you want to have a great credit score, pay your bills on time. And that goes for everything, not just mortgages. Now, it's very important for mortgages. That's where you're going to live, right? But
Right.
pay your phone bill on time, pay your water bill on time, your electricity bill, et cetera, et cetera. Whatever bills you have to pay them on time. And that helps build your credit. That's like the most, actually. That's the biggest percentage, 35% of your credit score is dictated by, can you pay your bills on time?
I want to share with my team. I want to share with my family. My credit score is at the 800. I'm in the 800 club, but it took me a long time to get there, and it is all about paying on time. I use a lot of my credit cards, but the way that I do is that I pay it all off before the due date. So I'm making multiple payments throughout the week to get that statement balance down. Not all the way down, but at least to that 30% usage. David said it best, pay it on time. If you're having problems paying it, they're going to charge you the late fee. The late fee is going to be only on the interest and on the mortgage. No, it's not going to be on the taxes. It's not going to be on the homeowner's insurance. Typically, depending on the lender, it's 5%. But speak to your lender. Let them know what's going on. They want to help you. They want to, if they have forbearance opportunities, they have opportunities from different cities to help you pay your bills to get back on track. If something happens, you lose, God forbid, you lose your job or there's something going on, let them know. Also, put a little money aside if you're able to. Put a little money aside, emergencies. You used to say 3 months, but now I would say 8 months. If you could save 8 months, put it in a CD for 6 months, at a time for emergency funds to help you. These are the tools that we need to do to survive.
With those 8 months that Bathsheba was talking about and how you determine that, you look at your income and you go, hey, how much do I make in a month? Multiply that by however many months, in this case, 8. And then there's your result. That's the goal for your emergency fund. And I recommend that you place that inside of a high interest yielding savings account. Now,
Right.
as of the time of this recording, there's some pretty good options out there. So definitely do your research on that before placing your money anywhere. Make sure it's FDIC insured.
Insured.
That's super important. All right,
Yes.
$250,000. All right, unless we're high dollar folks, that's extremely important because while we hope there is no emergency needed, the problem is if you don't have that emergency fund, guess what you're going to have to do in order to respond to said emergency? You will have to go in debt. Okay, and the problem with that is because that 30% you were talking about, Bathsheba, is that if we utilize more than 30% of our available credit, we're going to start deteriorating our credit score. That's another thing that can take away from our credit score. So we obviously up to 30%, whatever that is collectively amongst all of the credit lines you have available. So if you have
Yes.
multiple credit cards, then you put all those together and then it's 30% collectively. Now, obviously, be careful because per credit card, there can be issues there.
Per credit card, yes.
Yeah. So make sure it's a little mathy. All right. It's a little mathy for those who hate math. But Bathsheba said it best right there. You pay off your statements when they're due or beforehand. I do that on the daily.
I don't even wait. When I see it pending, I'm just transferring over.
Yeah.
I make sure I have the cash before I put it on the card.
Oh, yeah.
I live
Absolutely.
within my means.
Yes.
That's the goal, living within our means.
There won't be any sort of political or governmental or any sort of qualifying ordeal when it comes to living within our means. This is just a way to remind us to live within our means and also to treat credit like cash. If you're taking anything away from this video today, and I know this is unrelated to what we're going to be talking about, but if you're a first-time home buyer, you're a borrower, you're someone that's just into the home market for the first time, getting your feet wet, financial wisdom, if you're going to use credit, Because if you don't use credit, then great for you. That's awesome. But if you're going to use credit, like a lot of us are going to have to at some point, then make sure to treat it like cash. All right. I do
Yeah.
that all the time. And
Yeah.
I'm telling you, that's how we get our credit scores up, because I too am in that 800 club, partially because of financial wisdom and just
Yes.
many great mentors in my life.
Yeah.
But
Yes.
that can be you too, especially even if
Yes.
your credit is crappy right now.
Yes.
You can get up there. You can get there.
You can get there within 6 months. It just takes discipline and cutting things off and being consistent and never close a credit card
Oof.
line. Just don't use it. Use it once a year. Just
There you
don't close.
go.
Let them close you. You don't close them. Okay, I'm done.
Well, no. There's another important point. If you're buying a car and you finish paying off the car,
Uh-huh.
it automatically closes the account.
Uh-huh.
So be careful, because if that account
Oh,
closes, that impacts your credit.
see, I didn't even know that.
Yeah.
Thank you.
So that's so for example, my brother-in-law is currently paying a car,
Mm-hmm.
and I think he's got like 10 grand, something left on it, right? Most people
Mm-hmm.
somewhere along the line. So I told him when we're going through his finances one time, when you get to that car loan and you're paying that car loan off and you're about to apply for a house, you're getting close to that time frame, you really need your credit score to be kicking, pay it down to about $1. get,
Ah,
get it down all the way to that last moment, so it stays open. And if you have to pay interest on it, it's like $1. Oh wow,
right.
a couple of cents at worst case. But that's only if timing wise you're like getting really close to, like, I'm gonna buy a house and I'm really close to paying on my car and I just want to be done with that. So most people think that, most people feel that. I
Right.
understand that. But you need that in order to keep your credit score where it's at. Because you close that account, that's history of accounts right there. That's a smaller percentage. So it's not going to be as detrimental as not paying bills on time or overutilizing your credit like we've talked about recently, but it's still a factor. I think it's like 15% or something like that. It still
Yeah,
will have an impact. So word of the wise, I don't think that's everybody, because
right.
wow, who has a car loan at $1?
Right.
But if timing wise that's how it's going to pan out, then just pay it down to that last moment, whatever's the minimum you can have in there. If there are conditions, make sure to check that out. Obviously be careful, and always make sure that whenever you're going somewhere, you talk to somebody and get advice from the person who has helped you with that loan specifically. Okay, or look for online resource, make sure you understand.
I wanted to go
Oh yes.
up to where it talks about the right here, perfect. The total interest rate increases of payment adjustments, including combination of schedule arm rates changes and increased schedule under an interest rate buy down plan that occurred after the arm was originated must not have exceeded 2% for the interest rate adjustment or 15% for the payment adjustment if the lender qualifies to borrow on the basis of the mortgage rate that was in effect for the arm when it was originated and the arm underwriting guideline Fannie Mae must use at the time. So this is just protecting from the high cost loans. So this is why they don't want it to exceed, because they don't want you to receive payment shock and you're like, whoa, I can't afford this anymore. Because we talked about that in our prior classes, we want
Mhm.
to make sure you'll be able to afford the rest of part of your life. So this is important to know as well.
Big chunk of information there, but yeah, making
Mhm.
sure that it makes sense. I think that's what it boils down to, is like, hey,
Yes.
these interest rates are so high. Oh my God, I don't know if I can do this anymore. The payment shock, right? That's obviously, we're trying to avoid that. And I think Fannie Mae does a great job of saying how they're trying to avoid that too. And then it continues into modified mortgage, must provide a fixed interest rate.
Mhm.
Cookie cutter again, right? As we keep talking
Yes.
about, that's preferred A tier, S tier, right? When it comes to Fannie Mae, fixed rate is one of those
Yeah.
keywords. Let's see here, title insurance policy and any endorsements that are not impaired because of the option to convert to fixed rate or actual conversion. So just talking about title
Yes.
insurance, that can be kind of finicky, and there's a lot of different things, and we're not title insurance folks. So definitely make sure you're talking to the appropriate source, so you don't find yourself in a shocking situation. We just won't call it payment shock. We'll just call it something, fill in the blank, shock. If you find, don't want surprises. No surprises when it comes to finances, please. Unless you're going to get money. Okay. That's the only time. But make sure
Mm.
you get it and there's no problems later. Okay. So let's see here. Original loan amount, ARM did not exceed Fannie Mae's current maximum mortgage amount limitation. Going back to cookie cutter stuff right there.
It also talks about like if you come in and it was more than the loan limit, they will consider it. I think you're going right here. If the loan limits decreased between the time the arm was being converted or removed from the arms pool, Fannie Mae will still consider it. So there are some certain expectations. Like if you're in the process and they decide to decrease the loan limits, which I don't see them doing that anymore now, where we are now with inflations and stuff. But there
Sure.
was a time. Hmm.
And who knows? Maybe there'll be another time. It really,
Yeah,
that's the
you're right.
funny thing.
It's a full circle. It goes up
Yeah.
and down. Yep, it's a
Cyclical, as they say.
yeah,
Potentially cyclical. Yeah. Hopefully
yeah.
not, because arms are a bit of a troublemaker, but we shall see what the future holds. Let's see. As far as additional information, again, a lot of this is conditional, specific to case scenarios, and just really filtering it out to where it's just the stuff that Fannie Mae finds acceptable. So a lot of this may not even be applicable to a lot of people's situations, in all honesty. But just know that's their goal here with all of this information, is to make sure, again, with loan to value and combined loan to value and home equity, combined loan to value, all those different things it talks about there. And then delivery requirements and security instruments. So again, that's just more specifics, getting into making sure Fannie Mae gets what Fannie Mae wants to get out of
Yes,
kind of the Wild West, if you will, of mortgages, non-QM realm,
yes,
probably, or other ARM products that are out there. We have the modification agreement requirements as well, that talks about what they require when you're doing that conversion. And then mortgage documents for fixed rate conversion option. And it talks about the standard riders or addenda that provide the terms for conversion. So again, just making sure, checking all the boxes, making sure we're crossing all the T's and dotting the I's, if you will, when it comes to taking something from potentially anywhere and turning it into something that is acceptable, cookie cutter size, Fannie Mae guideline type stuff. That's all of what that covers essentially in those upper parts.
just want to make sure that everything is documented, making sure the documents are in order with everything. If there's anything that's meant to be changed, it has to be written in the document prior to conversion, or you have to create a new document, which is the modification document, to add to change to the changes. Like we always say, dotting your I's and crossing your T's, making sure everything is documented. If they need new title, basically, if they're able to convert it, they will convert it. If not, we're going to need a new application.
When converting, we can use this page if we're going to Fannie Mae from anywhere. And then on top of that, if it's within Fannie Mae, then it's like, well, these conditions must be met. And then from there, it's like, cool, if it's from all of these things, then this is what we're looking for as the final result. And
Yes,
it's kind of a brief overview of what this page entails.
high level overview. Yes.
Yeah, super high level. Temporary buy downs. Now this is what's kind of big right now in a lot of different lenders. They're always talking about this as their program this and their program that, temporary buy down this, temporary buy down that. I will go ahead and kick us off on this one here. When it comes to temporary buy downs, it's going to usually be some sort of like countdown,
Yes.
and then it goes to whatever the interest rate's supposed to be. And so understand that what that means is it's going to reduce the interest rate by those countdowns in most cases. Okay, it'll identify, like, for example, a 2-1 buy down. If you ever
Hmm.
hear that in the industry or as you're shopping for a mortgage, what does that mean? Well, first, it's going to reduce whatever the interest rate is by 2% for the first year. And then
Hmm.
as of the second year, it will only reduce it, instead of 2%, by 1%. And then by the third year, it will then become whatever interest rate is supposed to be. Now, technically speaking, clarification on technicality here, the interest rate's never changed. It's always been whatever it started at the whole time. The reason why we're paying less, though, is because whomever we're getting this loan through is essentially giving us a subsidiary or
Yes.
a stipend, an amount of money, in other words, that's going to reduce that interest rate accordingly to the product. And they're going to place that in the escrow ahead of time. So just know that
Hmm.
that's what they're going to do. And they're going to talk about that here on this page too, about like what happens to those funds in case we sell early or we
Yes.
convert it to something else, you know, do refinance, that kind of thing. So that's the big thing to grasp here, is like, we're okay. The lender's saying, hey, you want to do a buy down? Cool. Let's figure out what those percentages are. Let's figure out what product that is. Let's figure out what amount of money that is. Let's place that into the escrow account. And as you're paying it for the first and second or third, however many years in the countdown order, it's going to chip away that amount of money that they placed ahead of time in the account. So that way it feels like you are paying the lesser interest rate for those affected years. Hopefully that makes sense. We're going to have a math example in a little bit. So if you're a little lost right now, don't worry. We're going to swing back to that here in just a moment. But basically on this page here, this is what Fannie Mae's talking about when it comes to provisions for temporary interest buy down plans and what Fannie Mae deems acceptable.
Well, Buydowns is usually up to 3 years. So that's probably the most they'll do is up to 3 years. And would I do Buydown? Yeah, because there's a lot of benefits to it. There is some free money in there. So there is an advantage of it. You do sometimes have to pay upfront for a discounted interest rate, but with the Buydowns, it's like what David said, it's the same interest rate, but it's getting discounted or subsidized, and the lender's paying. Sometimes the lender will pay the difference. So it's just some free money to help you build up. It's really worth it getting into it. It talks about, like it said, it cannot exceed, the rate reduction does not exceed 3%, and the rate increase will not exceed 1% per year. It's a written agreement, and it does go to escrow, like you said. So we'll talk about more where the funds go if you were to sell and move forward with that. In no way the buy down plan changes the terms of the mortgage notes. So that's important. It's just a temporary opportunity. And then after that, your note will go back to what it was for the remaining of the mortgage period.
With the buy downs, it's an opportunity, right? Think of it like an opportunity to be able to pay lesser interest for a certain amount of years. Now, in this case, it talks about just the 3 years, and who knows, maybe there's loan products in the future where it's more than that. But for now, it will be upfront. Whatever the name of the product is, it'll essentially say it right then and there. You won't have any mysteries. And that's what's really nice about these, because it's literally in the name of your loan.
Yes.
3, 2, 1, buy down. You know what
Yes.
that is now. 2, 1, buy down. You know what that is now. Buy down funds provided by interested parties to the transaction. So it's talking about what we were just talking about with the lender's going to place this amount of money to help achieve the effect of having that lesser interest for however many of those years are for that product.
So this is different from seller concessions, which is maybe they help contribute with fixing something in the home or home repairs or paying for closing costs. So this is different from that.
Yes, an important distinction. In case you're before contract, you're at the negotiating table. There we go. That's the proper timing. And you're thinking, oh, well, I've heard about seller concessions. Is that this? And it's like, no, this is the actual loan product. So that is going to be paid for most likely by the lender. Now, there may be some special conditions, but for the most part, it's a lender paid product. And so the concessions is still on the table for whatever house you're getting into. So make sure you talk to your real estate agent about that. Make sure you know what you would like, and then see what the seller comes back with as far as what they can offer, and see if that still makes sense. I think that's another important thing too. We talk about numbers, we talk about percentages, but does it make sense to you in your situation? That's the question we really have to answer. Learning about it is helpful because at least generally when they start talking about these things, you have a familiarity, right? And so you can follow. But does it always make sense to everybody? No. The answer is no. You have to do the math, and then you have to look at it for the long term and see, hey, is this really going to be beneficial? I can't tell you how many people I know that don't think about money longer than maybe a few months at most, a year, even rarely 30 years. I don't know anybody that's thinking about money like that except for like loan geeks like us,
Yes.
So yeah, it's like the interest and so forth, those things. So I think that's a really important factor I wanted to throw in there, because all these mortgages are there for a long time. And so we have to, when we start getting into mortgages, when you yourself start getting your personal finances into mortgages, you have to start thinking long term. And then that's the thing you have to base on, is this the right decision for me and my family? Because nobody really talks about that. They're just like, oh yeah, you want to get a house? Let's go get a house. Cool. Everyone's checking the boxes. Hey, you're happy. They're happy. No one's getting technical. Nobody's asking like fiduciarily, is this a good financial decision for you, for me? So know that you got to do the math. You always got to do the math and make sure that especially with these larger purchases.
You can be eligible for the home, but is it something that you can commit to and afford to? So those are two different distinctions.
This brings me back to when we were talking about how living within your means. I think we were talking about that
Yes.
earlier with the credit. So this kind of piggybacks off of that idea of there's
Mhm.
no like rule about this,
Mhm.
right? If you want to be what they call home poor or house poor, that's what they call that, house poor.
Yes.
You have a
House phone.
house, but you can't do anything because
Anything
all your
else?
money is going to
What
the
is in
house,
the house?
right?
Right.
But there's no lender out there that's going to tell you, oh no, we can't lend you the money because you'll be house poor. That's not a
No.
rule. That is not a rule. But it should be a rule for you. You should make
Mhm.
that a rule for yourself. Hey, I want to live a life of abundance and I want to live right now. I don't want to wait till I'm 65.
Right.
I want to live right now. So you have to budget. You have to make things work with what you have right now. So when you do all the math, and it's like, hey, I'm going to be home poor, like more than 50% of my take home pay is going to be for housing. And now I got to get tight on everything else, going places, seeing people, doing things, buying things I
Right.
like, buying things I enjoy, experiences. That's really important. Experiences,
Experiencing.
they can be quite expensive, traveling places and hotels and all that stuff. So keep that in mind. I think a lot of experts will say to try and keep the amount that you make every month for housing, like what's dedicated to housing, in other words, try to keep that somewhere between the area of like 20-25% in that realm, maybe less. Obviously, the
Mhm.
lesser, the better, because housing is the most expensive thing we're ever going to pay for
Yes.
every month.
Realistically, 40%.
Yeah, well, that's because of the prices of houses at the
Yes.
moment. Yeah, so
Skyrocketed.
so
Yes.
when you have that conversation of, should I rent or
Yes.
should I buy? As loan officers, we shouldn't be saying, oh, well, maybe renting is a good idea, but we're trying to be fiduciaries here.
Yes.
Yeah, maybe renting is a better idea, at least during this season of life. There are seasons,
Yes.
right?
Their season.
So right now, at this time, under these conditions, maybe renting's the better option. And then you start building it up. And then eventually later, a new season begins. Hey, look, in this one, it's better to buy the house. That's when we talk. That's when we have these conversations. That's when we get you that home you want. I know it's not always going to pan out that way, but ideally it works out that way. Or living with parents and then to a house or, whatever. Some people have
Yes.
those advantages, right? So
Yes.
that's good too. I'm not denying that.
Buy
So,
down agreements. Let's talk about
yeah.
that. So this is the lenders giving you the incentive with the 3-2-1 buy down or a 2-1 buy down to help you get into your home. You must still continue to make payments on your mortgage note. So this is not saying that, oh, I don't have to pay for the next 3 years. No, you still have to make payments and they will cover the difference. And so when it comes back to you paying the full amount on whatever that term is, that's why they have the escrow. The lender has their own escrow and they have to show where the money is going when they're paying the mortgage note on your behalf, the portion of your interest on your behalf. The great news is that everybody's eligible except investment properties and cash out refinance transactions, and arms are restricted. You're already getting a discounted rate with the arms in the beginning so you can come in. So at certain levels it is restricted, but investors, this is more for those who are trying to be in their home. This is their homestead. And cash out refinancing, no, because you're trying to get cash out the home. So that's why it's not eligible for those two.
I think that would be really crazy if investor properties were eligible for buy downs. I'm just saying.
Right.
Now, hold on a second, guys.
Double
You have
dipping.
more than enough. Let's save some of the money that would be for people who let's be fair.
You don't need it. Yes.
Right, yeah, exactly. So investors out there, sorry, but you know what game
Yes.
you're playing. And then cash out
Yes.
refinances, obviously, that one is like, well, if you can cash out refinance and get a 2-1 buy down, it's like, well, wouldn't we just take a portion from the amount you're taking
To
out of
take
the
it
house?
from. Exactly.
So it's
Double dipping
contradictory.
too.
Yeah, it's a little contradictory. Yeah, maybe you're getting
Yes.
more money, but still, no. Just do the cash out refinance as its own thing. Qualifying the buyer or borrower, sorry. When underwriting loans that have a temporary interest rate buy down, the lender must qualify the borrower based on the note rate without consideration of the bought down rate. So that's very important because, and I think you were mentioning this a little bit ago, Bathsheba, if I'm not mistaken, but basically it's like, hey, we got to qualify them based on not the buy down stuff, the later on after the buy down stuff. That's how we
Yes.
place it. Okay. As far as qualification goes. So we're looking at LTVs and things like that. Like, okay, can you afford this in the eyes of the lender? So that's important distinction, because otherwise you're thinking, well, it's going to be down 2%. So that one, I'm like, no, no,
No.
sorry. That's going against the better interest of all parties involved, including
Yes.
yourself probably. So
Yeah.
just know that.
That can turn into
Oh
payment shock.
yeah. Oh yeah. So
Yes.
you want payment shock? Because that's how you get payment shock, right?
Yeah.
Let's see. Terms of buy down. Fannie Mae does not place a limit on the total dollar amount of an interest rate buy down. That's cool to know.
Mm-hmm.
The total dollar amount of an interest rate buy down must be consistent with the terms of the buy down period, which just makes
Yeah.
sense. An
Yep.
interest rate buy down plan must be for a buy down period no greater than 3 years. You were talking about this
Okay, 3
earlier.
years. Yeah.
Increases of not more than 1% in the portion of the interest rate paid by the borrower in each 1-year interval. So can't excess more than 1% per consecutive year of whatever buy down this
Yeah.
is. So
Hence the 3-2-1 buy down that they
right,
always do, or 2-1 buy down,
right.
just gradually.
I am curious to know what products are out there that don't do that. Like, I don't know. I haven't personally looked, but I'm
Right.
pretty sure there's probably some non-QM out there is why they had to make this distinction, because otherwise, why would they say this?
Exactly.
Let's see here. More frequent changes are permitted as long as the total annual increase does not exceed 1%. That's just clarifying that more of what we
Yes.
just talked about. And then we have the moderate and significant, which personally, those are some interesting choice words when it comes to distinguishing a measurement of something. Well, what is it? Well, it's kind of moderate. But how far? Well, it's quite significant. It's like, well, how many? Tell me a
Right.
number. Okay. So then that
Yes.
kind of distinguishes that in the thing, the difference of the 2 percentage points or less between the actual note rate
Yep.
and the bought down interest rate, and then a buy down period of 2 years or less. So it's specifying what does it mean by moderate, because it's legalese. Of course, they're going to do that. And then significant is the difference of 2 or more percentage points between the actual rate and the bought down rate, or a buy down period greater than 2 years. That's significant, according to Fannie
Yes.
Mae.
Greater than 2 years. Yes.
Oh, yeah. Then the buy down funds. Here's that fun part we were talking about. It's like, well, what happens to
Yes.
buy down funds under certain conditions? Well, it talks about that here in relation to Fannie Mae. So remember,
Mhm.
that's the lens we're looking through right now. So this is not how it's always going to be,
Right.
unless you're going with Fannie Mae. So here we go. Buy down accounts must be established and fully funded by the time the lender submits the mortgage to Fannie Mae for purchase or securitization. They don't want to deal with that. So make sure you got your ducks in a row, and then we'll take it from here. That's
Right.
what they're saying there. Funds for the buy down accounts must be deposited into a custodial bank accounts.
Yes.
Okay, so escrow, right? Buy down funds cannot be included in accounts with the lender's other corporate
Corporate
funds.
funds.
That's
That's to be separate.
that's just bad practice, guys. That's
Yes.
gonna get messy real fast. Don't do that.
No commingling, because they want
Yeah.
to make sure that you have the funds available to pay it. So.
Right. None of that sneaky stuff we talked about. I think it was like episode 3.
Yes.
Something where they talk about that. Episode 2 or 3. It's one of those two.
Yes.
My mind's a little foggy right now. Let's see here. The borrower's only interest in buy down funds is to have them applied toward payments as they come due under the note. So it's to
Yes.
achieve the goal of which was stated at the beginning of the whole agreement, right?
Yes.
To buy down the interest for a year or so. That's
Yes.
only what those funds can be used for during it being active, is what they're saying there. Buy down funds are not refundable unless the mortgage is paid off before all the funds have been applied. So it'd be a great goal, I guess, to pay the
Yeah.
house off as soon as possible, if that's
Within
even
3 years or 2 years.
yeah, I mean, yeah, at that point, I'm thinking you might have gone cash and just wait 3 years, but hey, that's cool.
Yes.
I'm totally down to help you with that loan. I'm sure Bathsheba feels the same.
Yes.
If that's what you feel is going to be most advantageous. And maybe it is. Maybe it is.
Yes.
Let's see. Buy down funds cannot be used to pay past due payments. So sorry, guys, this money's got a purpose and it's not that. Buy down funds, this final one here, cannot be used to reduce the mortgage amount for purposes of determining the LTV ratio. Oh, wow. I want to qualify using the ratio, the funds that are used to reduce the, no, sorry, guys. just like we can't use the initial interest rate at the 2-1 or 3-2-1 buy down for qualifying, the same can be said about the amount that they're going to fund that escrow account with ahead of time. You can't use that to help you qualify for. You have got to qualify on your own situation, your own circumstances, guys. Okay.
Yes.
Disposing of buy down funds.
Is the status. If the mortgage is paid in full, then you get a credit for the total amount required to pay off the mortgage, or they may be returned to either the borrower or to the lender at a specified at the buy down agreement. Most likely it will be sent back to the lender since it was the lender's promotion and incentive. It will probably be sent back to them. If it's foreclosed, the funds can be used to reduce a mortgage debt, which is nice. If the property is sold and the mortgage is assumed by the purchaser, the funds may continue to be used to reduce the mortgage payment under the original terms of the buy down. That's that assumed again. So if you're transferring the loan to someone else and they're going to pick up where you left off on that loan, then they can still use that buy down opportunity too. So that's very good too.
Oh yeah. Yeah. And we've talked about the assumption in the past, probably
Yes,
touched
we
on it a
have
little bit. But
too.
going back to the mortgage is foreclosed and the funds can be used to reduce the mortgage debt. I find that interesting that the lender would then be okay with utilizing it to reduce the debt, even though it's their money and it was their money they lent in the beginning too. So I guess maybe that's one way that they can sell it easier later.
If a loan gets returned within the first year, typically the lender has to pay back that loan. They have to buy it back from Fannie Mae because something went wrong. Then maybe it wasn't fully qualified mortgage QM. So they're checking the list and making sure, well, did you make sure the 12-month statements? Did you make sure they were able to afford it? They're going to check to make sure everything gets good. If everything is good, then they're like, well, something happened within the first 3 years of you getting a home and you got foreclosed. They have this money out here. They want to reduce it, like you said, to get it back in. But a mortgage typically should not be being foreclosed within 2-1 buy down or 3-1 buy down because that's within 3 years.
And like we said earlier, if that was the case, it might have been better off just waiting 3 years before buying the house. But then again, maybe that house was there right then and you had to have it. And hey, you know what? That's fine too.
Yes.
That is okay. Everyone's situations are a little bit different, and no one has a right or wrong answer when it comes to these types of things. On the last bit here, we got the mortgage-backed securities or MBS pool considerations. And so that just talks about how they would pool that. So when a lender includes a mortgage with a significant interest rate buy down, such as 3-2-1 buy down or 3-2-1 temporary interest rate buy down, I guess that's what they would classify as significant for the more layman's terms. In an MSB pool, there are restrictions on the maximum amount of loans that can have a significant buy down or temporary buy down. And if you're a borrower, you will never truly have to worry about that. So that is more for the investors and the lenders and us loan officers, I guess, if it's coming from a pool. Then it talks about delivery requirements as the final bit there, and it just specifies some very specific, I'm not sure if those are forms. I think those are forms. They're either forms or the reference points within something else, the SFC 009 and SFC 014. So as far as how they're coded, that's the codes. That's what they are, the codes.
Yes.
Secret.
So I just want to say, hey, you're getting a discount on your house payment for 3 years with no extra fee or strings attached. This is free money. So the buy downs are good deals. If you could take advantage of it, I would do it.
The math makes sense.
If the math is mathing, do it.
Indeed. And actually, that's a perfect transition to the math because we have a little, this is going to be rather brief, but we have the formula that you can utilize in order to really see what a temporary buy down, like what do lenders look at when they're making these products and how much money are they fronting essentially into these loans when they have a qualified borrower. So let's look at that here next. Now that we've gone through the 2 guidelines here today and had plenty of nuggets, more nuggets than I anticipated, especially about credit today. This is fantastic. More nuggets of credit joy. So if you have a business, LLC, S Corp, C Corporation, partnership, even a sole proprietorship in some cases, if you own your business, you can then get what's known as credit for your business, which does not have the same scrutinization as personal in most cases. Now, there are
Right.
some cases where they're checking both your personal and the business, so be careful about that.
Okay.
However, it's not, they don't have all the same categories for the business. Because remember, a business is essentially like another entity. It's a
The T.
person, right?
Right.
So if your business gets sued, you're not getting sued. So
Right.
if you lose that argument in court or you settle, right, then your business is responsible for paying that, not you, the person. That's the
Right.
advantage of a limited liability corporation, for example. That's why
Right.
it's called that. You have limited liability for what your business is deemed responsible for. So you don't have to worry about losing your retirement accounts if you're having to pay
Right.
some huge amount of money that you can't afford off the bat and you're
Mhm.
liquidizing things, you're losing your properties, blah, blah, blah. Now, this is going into a realm that is definitely not our wheelhouse, but
Right.
in the nature of finance, these things do come up in conversation. And so when it comes to the business credit, it's not that you can just utilize as much as you want, so to speak. The 30% rule still applies there, in all honesty, but it's not going to affect you, the person, if it's
Mhm.
only reporting to the business credit score. So that's cool because then even if you are late, it's not affecting you, the person, it's affecting your business.
Business. Yes.
That's the biggest advantage. That's some of the things they're separate, right? Because the business is
Yes.
an entity. So that's why you have to apply with your business's ID number and not your
Yes.
social.
EIN number. Yes.
Exactly, the EIN, right? The employer
Mhm.
identification number, I think is what that is. A little bit of wisdom from what I know
Yes.
about the credit and business. Pay your bills on time, even if it's for your business. That's
Yes.
still
Always
kind of
pay.
the golden rule. That's right. Always pay it up when it's due and be careful of offers in the credit scene because, oh boy, the predators. I am going to show the formula. So let me get a text. Let me just place that formula here. Okay. Let's explain exactly how this works. Say 2-1 buy down. Let's say that's the title of that loan product. And so that's the loan offer that you're given. So you're like, oh,
Right.
okay, cool. So the next thing you need to figure out is what is my loan amount? Okay.
Yeah.
Not the sales price. What is my loan amount? Okay.
Right.
So very important distinction because those two things can get very confusing. So let's say when it's all said and done, your down payment and what have you, your loan amount is, let's say, 200,000. Okay.
Okay.
That's a good time in the housing market. That's definitely not right now, but let's
Right.
just say that was the case, a $200,000 loan, not a sales price. Okay. Making sure we understand that. This is a 2-1 buy down. So we know it's 2% the first year and reduction of interest. And then it's a 1% reduction in interest the second year. And
Oh, yeah.
then as of the third year, it now becomes whatever the interest rate is supposed to have been this whole time, basically. In our formula, we want to know what the buy down points are. And that essentially will tell us like how much money is going to be funded for this temporary buy down from the lender, right? Because you're wondering, well, how much money are we talking about, right? These funds
Right.
we were talking about earlier. We got another loan amount. That's the first thing. We know it's 200,000. And we have
Mm-hmm.
to times that by the percentage. Okay, so the percentage is basically going to be the 2-1 buy down. That's what we're talking about, percentage, not the interest rate percentage. That's where this can get confusing. Okay,
Right.
so the 2-1 buy down is 2 plus 1 is 3. So it's
Mm.
3%. Okay,
Okay.
that's how that's going to work. That's a very, very important distinction. If you don't have that context, you might get this wrong. And then afterwards, we're going to divide the result by 100. 200,000. And that's going to be multiplied by 3. And then we divide by 100, which gets us 6,000. 6,000 is how much they would fund in this example. That's the amount of money they're going to place in the escrow account.
6,000 is what is the
Right.
total amount they're paying for the total buy down.
Buy down fund, as it's called, as we've discovered from the guidelines today.
Mm-hmm.
Place that ahead of time into the escrow account.
Yes.
And that's what's going to help to give you that effect, that achieved effect. So as you now know the inner workings
Yeah.
of the temporary buy down. That was the big thing we wanted to show here.
Look at the savings. You saved yourself 6,000 on top of perhaps you got seller concessions, on top of assistance for closing costs, on top of grants, on top of whatever. So, this is a great opportunity. So if you find it, learn more about it, take advantage about it, give us a call. This is, a great opportunity.
You could break that down too if you wanted to a little bit further. 2%, 200,000, and then 1%, 200,000, then divide those numbers by 12. And that'll really give you the true number for each of those consecutive years. So if you really want to know what that looks like, mathematically speaking, that'd be how you would achieve that. But either way, the one light is, hey, I'm saving $6,000. What am I going to do with that saved $6,000? Am I going to invest that? Am I going to save that up? What am I doing? So it gives you an opportunity to go, I know the number. And now what am I going to do with that? So you can plan for that even before you get the loan. That's super powerful. If the math's making sense with your financial situation, that's the other thing. Let's go ahead and land the plane there.
Press that like button. We
That's right.
appreciate it.
Share it with those who are in the housing market right now. For those who are, first-time homebuyers, especially, this is really important for them. Even veterans, maybe they didn't know some of this stuff. Fellow loan officers, if you're watching, make sure that you are following through with the things that you read in here, and make sure you're always reading all of the guidelines, for they're ever changing. I'm going to display all of our information on the screen right now. If you would like to work with us, give us a call. Like Bathsheba was saying, we're more than happy to see how we can assist, get you into the home you want to get into, hopefully, and see what we can do.
Yes. Thank you so much, David. Thank you, everybody.
And thank you, Bathsheba. Until next time, guys, be blessed and have a great one.
Bye-bye.